Welcome back to 5 Good Questions. I'm your host, Jake Taylor. Our guest today is Edward Chancellor. Edward is a financial historian, journalist, and investment strategist. In the early 1990s, he worked for Lazard Brothers, and in 2008, he joined GMO's asset allocation team. He's the author of one of my favorite financial history books, Take the Hindmost. Today, we're going to be discussing his new book, Capital Returns. This book added a few investment checklist items for me, which I'm always grateful for. So let's ask Edward 5 good questions. All right, welcome back to the show, everybody. My guest today is Edward Chancellor, author of Capital Returns. Hey, Edward, thank you so much for taking the time to chat with us today.
Pleasure.
I have to confess that I was a huge fan of Take the Hindmost. And it was, it read so easily and had so many interesting historical stories that I hadn't read other places. I thought it was just fantastic.
Good. That's gratifying.
Good. Yeah, I'm sure it was a lot of work to put that much information together. So your newest book now, Capital Returns, similarly, I really enjoyed it. And basically what the book is, and maybe you can describe this better, but is you basically compiled and annotated a bunch of Marathon Asset Management's letters to shareholders or clients, I guess. Is that correct?
Yes. This book, Capital Returns, is a collection or a selection of letters to investors by this London-based investment firm, Marathon Asset Management. Now, everything else being equal, letters from investment firms to their clients are some of the most boring literature available, as I'm sure you're aware. However, what distinguishes Marathon is that they apply a particular approach to investment, which they apply in a very disciplined way, and which has delivered very successful results for them. I think they've been around for roughly 25 years, and they've consistently outperformed their, I'm not quite sure what their benchmark is, but I think it's a world equity benchmark, and they've consistently outperformed it in a way that, through boom times and bad times, boom times and busts, and the approach they employ, they call the capital cycle approach to investment, and that's an approach that I'm particularly sympathetic to. And so this is the second book that I've edited on behalf of Marathon. The first one was called Capital Account, and it was a book of investment reports dealing with the sort of .com boom and its immediate aftermath. And this follows this covers the following decade.
Yeah, and I have to say that as someone who does primary research myself, I was really impressed. I almost had a little bit of research envy over their letters. Just the depth of research and the how concise they were in their observations. It's pretty impressive.
Well, some of the concision comes from my heavy editing pieces, but the point, and also bear in mind, this is a selection of 60 or 70 letters from a universe of 1,200 or thereabouts. So, it is, as I say in the introduction, there's an element of survivorship bias. And it's not, the aim is not to make the Marathon or the Marathon analysts look smart, because in some ways, I don't think they are any smarter than other people in the investment world. It's not really a question of being smart. It's a question of having an approach that seems to work.
So we'll start with just get into question number one, which is basically like, what is this approach, this capital cycle theory, just simply explained?
Yeah, well, simply explained is that, in my view, most investors divide themselves into value category or growth category. So there's sort of a split in the investment world into different categories. The other thing is that a lot of investors are specialists, and this is particularly on the brokerage side. They cover particular sectors. They're specialists rather than generalists. Mm-hmm. And then another point I'd make is that a lot of investors spend time thinking about most of their time thinking about trying to project demand. How many, so take aircraft manufacturing, how many aircraft are going to be sold to emerging markets in 10, 15 years time? Or how many cars will China consume in 2030 or whatever? Now, the capital cycle approach is somewhat different. The focus of the capital cycle is to look at where capital is going today, where supply is increasing. So to look at supply rather than demand, and see that changes in supply are what drive mean reversion in the world, in the world of business, and therefore in the world of investment, and that therefore, and to understand that investment returns are actually inversely proportionate to the amount of capital that is thrown at a problem, and that, in a way, it's a very simple approach, because what I'm saying is you should, with a capital cycle approach, is you spend 90% of your time looking at the supply side and only 10% of your time looking at demand conditions. And the reason you do that is that actually it's very difficult to project demand accurately. Now, for instance, China has been slowing, and all those people 3 or 4 years ago who had these projections for Chinese economic, they made these projections of let's say, 1 billion urban consumers, and then they would change the proportion. They'd have a sort of fantasy about what Chinese GDP would be, and then they'd have a fantasy about what China's consumption share of GDP was, and then they would work out
per capita,
how many cars will be demanded, and then you see current production, and you say, oh well, they're going to sell it. And this is, it's a very complicated process, all that, but it gives you a result that has no accuracy whatsoever. If you look on the supply side, you can see an industry, for instance, the Chinese car industry, where capacity is massively increased and is immensely fragmented. So if you focus on the supply side, you get better insights which deliver more accurate investment results than if you spend your time thinking about demand. And the other reason to do this is that everyone else, most other investors are extrapolating in a linear fashion into the future, whereas a person who is adopting the capital cycle approach is actually the very term cycle is in the words. You're thinking cyclically in a cyclical world in which your competitors are extrapolating in a linear fashion. So that in itself gives you a huge advantage. The other key distinction between the capital cycle approach and say conventional investing is that whereas conventional investing is often siloed into value and growth, is the capital cycle allows you in a way to be both a value and a growth investor. I'm sure you're aware, you suggest to a value investor a stock that is trading on relatively high PE, and they say, yeah, it's a great company, but it's expensive. And a value investor will then go out and buy an absolute rubbishy business because it's cheap. Now that is not in a way, to my mind, an intelligent or useful way of investing. The better approach, or at least the approach advocated by the capital cycle, is to look at a company that is expensive, so to speak, and a growth stock, and then look at what's happening in the supply side of that for that company and the industry in which it operates. And if the supply conditions are very disciplined, if there's no massive increase in capital spending and so on and so forth, then you might make the case, after analysing it, that the market is estimating that its returns are going to revert to the mean faster than will actually be the case. So you can buy an expensive stock, and after all, this is what Warren Buffett made a lot of his money doing, sure, buying in an expensive stock when the supply conditions are disciplined. Now, conversely, value investors constantly falling into value traps, and they fall into value traps because they're buying something, a stock that is cheap, and they are not paying sufficient attention to the changing supply conditions or investment conditions within that industry. And I would say a classic case of that was back in 2005, when a number of value investors, including Bill Miller at Legg Mason, were flagging purchases of US home builders. Oh, yeah. And if you remember, the argument at the time was that home builders were trading at a sort of cyclical trough on a price to book basis. So I think at the time they were trading marginally above book value, or they may have been at a slight discount to book, but it doesn't really make a difference. Now, so the value investors said these are cheap stocks. There may be, there may be a bit of a downturn in the housing market and so on and so forth, but these are something to hold and get a decent return from. Now, to my mind, the mistake of that analysis was not that there was a financial crisis around the corner, because there was a financial. But leaving that aside, the real mistake of that analysis is that the US home builders had massively increased supply, both, and you would see that massive increasing supply to the US housing market, but they'd also increased the size of their book. So if you're a stock analyst, is you take a stock like KB Home, and you see that it was trading a book, but the book had been compounding at 35% a year for 5 years. And what happened subsequently is that KB had to write off, I think, well, I'm not saying KB necessarily, but US home builders, as far as I remember, wrote off about 75% of their book. So you actually lost a huge amount. Their price to book ratio didn't particularly change. Right. But just you still lost 75% of your money. And actually, if you look at the UK home builders, they also, British financial system also, took a steep downturn. UK housing was also, so to speak, in a bubble in 2006-07, in terms of prices being high relative to income, but there was no change in supply, or relatively little change in supply, owing to, as you can, a bit like California and the east coast of the states, just due to building restrictions. And in addition, the UK home building was a very cartelized industry. There were only about 3 or 4 major players, absolutely dominated. They were the only people who could ever get permission, and they remembered the bust of the early 1990s. They'd cartelized. They had the planning authorities stitched up, and they weren't increasing supply despite being. Now, their stocks also took a dive, like KB Home, but they came back much quicker because there was no write down to book in this case. So even if a lot of value investors will say, oh, I don't know anything about macroeconomics and so on and so forth. But even if you know nothing about macroeconomics and don't want to take a macroeconomic view, you can still actually use the capital cycle approach to sort of steer clear of bubbles and crises. And I'd go a bit further and say that there is a tendency of people to look at asset price bubbles or speculative bubbles purely from a price perspective. The market was in a bubble. It was trading on a PE of 35 or whatever, or Japan PE of 70 in 89. Now, my view is that the bubble is as much in the capital allocation the capital allocation within an economy as it is within the price. Now, everybody is identifying bubbles on a price basis nowadays. But what I argue, and what I think the capital cycle approach is, identify the bubble from the capital allocation. And what I can tell you is that every major bubble, apart from, let's say, the tulip mania, every major bubble actually involves a huge misallocation of capital, or if you will, if you want to put it a different way, a huge increase in capital spending, which then brings about lower returns. And that's true in an aggregate level, but it's also true because most bubbles are not on the aggregate market level. They're most within the sectors.
Yeah.
And if you wanted another example, take global mining stocks quite recently. In 2012, those mining stocks, the Bloomberg Mining Index, was trading at half the price to book value as it had been trading at in the period before the financial crisis. It was also trading, as far as I remember, on a price-earnings ratio of about 10 times. Now, if you had been, well, and in addition, at the time, mining stocks were quite heavily weighted in the global equity indices, not in the US because they're relatively small in the US, but say, I mean, the FTSE 100 had some pretty big giants there, Anglo-American, BHP, Billiton, Glencore, and so forth. So it had quite a heavy weighting in the equity indices around 2012. Now, a value investor, these stocks are cheap, and then half an eye on China and the prospective billion consumers and so on and so forth, and they say, well, you have good prospect demand and you have cheap stocks. What's not to like? Well, from the capital cycle approach, you say, well, hang on a sec, take iron ore. Is it over the last decade, iron ore production has increased 3.5 times? That now here's a capital cycle metric for you, a way to look at how to apply this as a stock picking way, is the Capex to depreciation ratio of the miners was at an all-time elevated level, and in addition, the cost curve for the miners had come right down. So the new mines that were coming on at a lower cost than the old mines. So you had everything suggesting, from a capital cycle perspective, that this was a sector you wish to stay away from. And since that time, since 2012, they've had a rebound in the last couple of weeks. But when I last looked at it, the Bloomberg and this was at the beginning of this year, the Bloomberg Mining Index was down 65% since 2012. So you had trading, as I say, on a PE of 10. And it loses 65%. It doesn't sound right from a sort of normal value perspective, but from a capital cycle perspective, it makes absolute sense.
Yeah. So as a follow-up kind of question to that, number two, of how do you, if you're a CEO in one of these industries and you notice that kind of all of your competitors seem to be overspending, there's kind of a game theory aspect to this. What do you do in that situation when you're, I've heard it, Warren Buffett describe it as everybody starts standing up to get a better view of the parade, but no one's actually seeing any better.
Yes, I mean, look, one is tempted to blame management for overinvesting, but in this era of where CEOs anyhow have a fairly high turnover, weak tenure at the job, and when you have these activists yapping at their heels, and where also you have stock-based compensation that can set you up for many generations, you will do what the market demands of you, and in a boom period, in a pickup in the capital cycle, and go back to the miners, in a pickup of the capital cycle, the market will reward you for investing. So the market doesn't market by definition doesn't get the capital cycle, and so it rewards you. And if you don't play the game, it's exactly the same as with investment. If you don't play the game, you face career risk, and that career risk. Imagine if someone like me, sort of smart ass, trying to run BHP Billiton or wherever, back in 2005. There's no doubt that I would be sacked because everyone would come along and say, we got to start this mine. China demand is increasing 10% a year. And you have to do it for two reasons. Well, you have to do it first of all because your share price will go. Relative share price performance will be poor if you don't play the game. And secondly, in an industry like mining, global mining, which is fairly consolidated, if one person doesn't play the game, well, that changes the dynamics of the capital cycle, which means that the other guys pick up the profits that you have left behind. And in fact, because you didn't join the game, you've actually helped extend the cycle for the others. So in a way, you can't win. The way you can win is if you A, control the company, or B, are so highly respected by your shareholders and can clearly articulate your position. I've been in this business for 40 years. I've seen cycles come and go, and I control 51% of the shares in this company. So I'm not going to, but most of them, that's not how it works realistically.
There's a reputational capital cycle theory.
Exactly. And the same exact, same is the case with, for investors is, one of the things about capital cycle investing is the cycles take a long time to play out. And each industry has its own cycle, and each cycle is somewhat different from the previous cycle. So, you have to take a position, and you have to hold with that position. Now, that may mean, if you hold with it, and while the market's going in the other direction, that you will underperform for a while. Now, take for instance Marathon, who have elaborated this capital cycle approach. In the 1990s, they were applying capital cycle analysis to the TMT sector, telecoms, media, telecommunications, technology. It was technology, media, telecommunications. Now, that meant that they weren't buying, Nokia and Ericsson and Cisco and Intel and let alone, I suppose, Amazon and all the the upcoming internet companies at the time. Now, what did that mean? And as and they were in the company of a lot of value investors, but the value investors were taking that bet because the technology stocks were trading on, I don't know, PE is 70 times or whatever.
Yeah,
no, but Marathon they were taking it obviously partly on valuation grounds, but the rationale for it is that there was a huge increase in technology spending and so on and so forth, and that therefore, and if you think in the first book I edited for Marathon, there were a number of examples of technology overspending, and if you remember, go back to people forecasting demand rather than paying attention to supply, is in the late 1990s, companies like WorldCom, in all their investor presentations, they would show a slide that was showing that data traffic was doubling every 3 months or whatever.
Yeah. And
actually, this is completely inaccurate. It was a factoid, that no one really quite knows where it originated. But it just wasn't the case, and no one bothered to check it. So everyone was pinning their sort of investment projections, cash flow forecasts, or whatever off a demand forecast that was even at its time inaccurate. And what was the result was, within 2 or 3 years, the excess capacity of fiber optics, which had been put in by the likes of WorldCom and Global Crossing, and I think Enron was in that business too. That had excess capacity of 95%, and then you had the Nasdaq crash and so on and so forth. So and then and the capital cycle approach allows you 2 or 3 years after that bust to see the capital has come out of the industry, and then to be a bit more constructive.
So in question number 3, kind of following on with that, with a difference between a kind of a capital cycle theorist and a value investor, they both seem like they're trying to buy at kind of peak pessimism. And with a value investor, they're looking for the market is very pessimistic about the outlook of a company, whereas almost the capital cycle seems like management is very pessimistic about the outlook of an industry, and they're no longer investing in it. Is that an accurate description?
Yeah, no. I mean, there are many different types of value investors. I mean, is Seth Klarman is a value investor, I take it. A good value investor is not just looking at price, at price, price to earnings, price to book. Now, but what I'm trying to highlight in this book and in the previous book is that it's not just about investor expectations. I think too much, is made of it, euphoria and depression. Sell, it makes perfect sense. Sell when everyone's, optimistic, and buy when they're pessimistic. Well, that is not a sufficient amount of information to make a sensible decision. Yeah, you might be very optimistic about an industry in which, about a business that has got its industry so tied up that no one can assail it. I mean, take, for instance, recently, you've got, Google and Amazon. They've got, people have been, absolutely, or even in, the 1990s Microsoft, you could be pretty optimistic about those companies and still make a lot of money because no one was coming in. The supply conditions were not changing. So from the capital cycle perspective, you're not just thinking about selling when optimistic. You're selling when everyone's optimistic because the supply conditions are deteriorating. Go back to the TMT bubble. Marathon at the time used to keep prospectuses of TMT flotations in their back office on a month-by-month basis, and you could just see them.
It's like a histogram.
Yeah, and actually, the IPO is a very good indicator of where capital is being allocated, as is M&A, as is high-yield debt issuance. All these are indicators of where the capital cycle is going, and so the capital cycle. It so happens that in investor expectations and capital conditions tend to move in tandem, but not always. For instance, it may be in the bust. Take, for instance, the mining companies. It's obvious, since third quarter of last year, that sentiment had turned really negative on the miners. There was stories about Glencore going bust. Yeah, now. You might think, and these stocks are looking cheap. I don't know the value metrics to the, off the top of my head, but I take it the stocks were, having lost 65% of their value when they weren't trading at very high levels beforehand, were looking pretty damn cheap. Now, I think from a capital cycle perspective, from a value investor, you probably say, I'm going to hold my nose and buy the stock. From a capital cycle perspective, you'll say, well, hang on a sec. Is any capacity being taken out of the industry? Now, up till recently, this story is beginning to change because Anglo-American have this year announced that they're closing a lot and so on. But the general picture of global mining, as far as I gather, is, as I mentioned to you before, is new supply is coming on the stream at lower cost. And that lower cost, the lower marginal cost of production, is below, I don't know where iron ore is trading now, but when I last looked, it was at half the iron ore price. Right? They could bring on, likes of BHP, could bring on iron ore production at about $15 a ton. Now, the CEO of BHP was on the record last year as saying the lowest cost producer has a right to continue producing.
Right.
Well, to my mind, that means that those guys are still
planning on producing.
Well, they're going to be at each other's throats for a while. Now, even if you didn't have any thought about China and Chinese demand, I think you would be waiting from a capital cycle perspective. You'd be waiting for better industry consolidation and for the cuts to come through and so on and so forth. So, and one of the things that the marathon people have told me is that they've cut their hands so often, catching falling knives with this, and in some ways, from a capital cycle perspective, you can afford to be, by and large, to be patient. Now, I would say, one of the things I have looked at a bit recently is the energy sector. Now, one or two of the pieces in that book, Capital Returns, describes the energy sector from a capital cycle perspective, and is pretty negative about it fairly early on. And they look at things like they observe, for instance, that the cash conversion rate of the oil companies prior to the sort of downturn over the last couple of years was very poor. In other words, that's the ratio of reported profitability to free cash flow. Now, if you are in a negative capital cycle, you will be investing all your reported profitability. Now, as you know, the problem with the oil majors is that they were investing that money to try and extract new oil at a higher and higher oil price. Now, I actually think that the capital cycle for the oil companies is in a very different position from the miners. So sentiment, has been equally depressed, if not more depressed. Mm-hmm. But actually what you see is that, I think off the top of my head, I'm saying something like 350, $450 billion of Capex were cut last year. And actually someone did a back of the envelope calculation for me, suggesting that the average, if you translated that into Capex costs at $20 a barrel of fresh oil, that was going to lead over the next 10 years to a loss of, 4 to 5 million barrels of oil a day. In other words, for the next 10 years, in 1 year, they'd taken out 5% or 6% of supply. So I actually think that the sentiment is negative in both mining and in oil, but that oil has, from a capital cycle perspective, a very strong chance, to my mind, of a rebound. And look, I'm not saying the analysis is for an individual to undertake, and anyone who, it's just like any other approach to investing. You can have an approach to investing, you can have a discipline, and you can still make god-awful mistakes. Yeah.
Sure.
And you can also disagree among friends. Like, for instance, the marathon guys, I don't think they really agree with my position on oil. But I know other people who know the oil industry who've approached it, in exactly the same way. And the basic way to see it is that, well, one of the things that marathons say, put in the book, is, it's the old market saying that the best cure for high prices is high prices, and conversely, the best cure for low prices is low prices. So, right. And I should say that another aspect of the capital cycle approach is that it tends to work better if you're a generalist. I mean, someone like me, I don't really believe, I don't know one industry particularly better from another, but I do know I have a reasonably broad historical knowledge, and I can what I think is interesting about the capital cycle is that it tends to work better if you apply the discipline that you've learnt in one sector to another sector, or even from one economy to another economy. So, in that sense, the generalist approach, and that generalist approach also sort of eschews overly detailed, spreadsheets,
right.
Sort of going out 20 years with residual values and so on. So that it's not, that's an exercise in keeping you busy, but it doesn't really sort of deliver very much.
Probably better to be precisely or approximately right than precisely wrong in this case.
Yes, precisely randomly wrong.
Yeah. So where, kind of question number 4, where would you make a mistake? And what I'm imagining is, at some point there's an industry that doesn't come back, and there are no more returns on capital. Like, let's say a wagon wheel. At some point that probably looked good. Nobody was spending money on wagon wheels anymore, from an investment standpoint. How do we avoid that kind of obsolescence? And I imagine obsolescence being one of the potential pitfalls of this.
There are many ways to lose money. I mean, look, obsolescence, yes. Although Marathon liked to joke that Hermes is the last buggy whip company, but it is true. Look, obsolescence, and where does obsolescence particularly come from? Comes from technological change. So, before Blockbuster went down, it probably had 90% of the US video rental business, and obviously in the the internet era has been one in which a lot of Warren Buffett moats have been breached, and so I think that that is one real problem. I think the second real problem is managers not behaving. Look, why does value tend to work and growth not work? Well, value tends to work, and this is what, and I mentioned this in the book, and I don't think value investors really understand this. Is value works because companies that are trading below book have a strong incentive not to continue investing, but sometimes they don't heed that incentive and continue investing. So it may be that management is not responsive to the signals shown by their industry or by the market price. So in that sense, management's that's a problem. I think a third problem with capital cycle is globalization. You have an industry such as the paper industry or the steel industry that had been relatively national, and say European steel consolidated, and that seemed like a good idea, and then suddenly China comes on with a huge amount of excess supply, and when its own market dries up, it starts dumping steel in Europe, and the local near monopoly producer gets screwed. So globalization is another sort of breach of the moat. I think that government interference is a real threat. I mean, look, take the global auto industry after 2000 and after the financial crisis. Now, look, if the European auto industry, as far as it didn't really consolidate in any way. I can't think of any. There was a bit. I can't think of any consolidation. There was you had the Fiat Chrysler merger. You had Obama. Frankly, overwriting, creditor laws in order to keep General Motors in business, and therefore you didn't really have the shift in you didn't have the rationalization on the supply side. And then you get a country like China, in which you have this quasi-command economy with state-owned enterprises, where there is no rationalization.
Yeah, you
that
can't.
One can see of.
That's a tough game theory to predict.
Is what?
And that's a difficult game theory to predict there.
But it's not really a game theory. The point is the capital cycle is not going to work because the management and the government will not tolerate it. So I think that you might not analyze an industry quite well to see what its threats are, and I actually think the capital cycle approach can really be very easily incorporated in Michael Porter's 5 forces analysis. But you have to. One of the things that the 5 forces analysis doesn't contain is the risk of government. Yeah, and I have to say that in Europe, where European governments are always interfering, and in China, it is an absolute. The capital cycle will not work normally, and perhaps that's the wrong way to say it, because it won't. You won't get a rational cycle. In China, I actually think the capital cycle, and I was working till a couple of years ago at GMO in Boston, and that was largely a sort of value-oriented asset allocation approach. And I had a number of concerns about China, but I think from an investment perspective, Chinese market always looks cheap. Well, aside from that period of the bubble that burst last July, but that was a relatively short period. But it's often trading on a sort of PE of 10 times or thereabouts, and therefore it looks cheap. But then if you look at it, the Chinese market has this very high level of capex to depreciation. It has very high levels of asset growth. It has very low levels of cash conversion. In profitability and so forth. So it always, to me, China flags, from an investment perspective, very negative from a credit cycle perspective, but really very negative from a capital cycle perspective. And there's one other thing I would add is that this capital cycle perspective, you can, if you wish, fuse it with a sort of credit cycle view, because after all, you can just look at banks and their assets from a capital cycle perspective and say, are the banks expanding their assets? And I think, in this instance, you also have to take into account any shadow banking that is going on. And then if you look at banks, just say, okay, I'm going to treat a bank like any other industry and say, what is happening to the supply conditions in this industry? And if you see the assets are growing, well, then that tells you, from a capital cycle perspective, that's a red flag. From a credit cycle perspective, it's another. So in a way, I actually think, I think the credit cycle and capital cycle are, they have a very big overlap, as you can imagine, because a lot of capital is funded with credit. And valuation normally, sort of 80% of the time, valuation goes with them. But sometimes valuation strays off on its own, and that's when people get whacked.
Yeah. So question number 5 is basically, how do we tell a good capital allocator when it comes to management side? And I'm coming to mind of like Jeff Bezos, let's say. He's been putting money to work now for 18, 19 years, and it's hard to tell exactly, like there's always so much reinvestment happening at Amazon. It's almost hard to tell, like, is it good allocation of capital or not? Like, is this ever going to turn into like an exceptionally profitable, high ROIC business overall, because they're always plowing money back in?
Well, I mean, it's a good question, and it's a difficult question, because I think that you have to examine each industry and each company quite closely. And one of the tenets of Marathon's capital cycle approach is they feel quite strongly that that a lot is to be gained from questioning individual management. There are some people, who are of the view that some investors and strategists are of the view that meeting management is a waste of time because they're so prepped by their investor relations people and financial PR people that they're just like a politician. They're on message,
and they're usually pretty good salespeople. That's how you get there.
And the other thing is that there is this sort of reciprocity tendency. So
sure.
Once they've looked you in the eyes and said that you asked a smart question, you give them the benefit of the doubt, and so on. So now, so I think first of all, how can you tell a good manager is you want to, and this is only open to professional investors rather than retail investors. You actually want to meet management. And I think what you want to do is then to find out whether they understand the cycle that they're operating in, and whether they are. And I think part of that is you want to see whether they're acting in a contrarian way rather than in a pro-cyclical way. And we go back to the to the mining companies. It's clear that the mining management managers like Glencore and BHP, Glencore bid for and acquired Xstrata shortly before, I can't remember, either before or roughly at the time of its flotation. BHP was going out bidding for, I can't remember, some Canadian potash business at a huge valuation and so forth. And so you could see a lot of M&A activity in that industry was hubristic and a sign of poor capital allocation, if you will, or a failure to understand the capital cycle. Now, I mean, I don't think that all the people will tell you from a sort of quant perspective that M&A is value destroying. I think that's too much of a generalization. I think that M&A, which is empire building or on the up cycle of a capital cycle, is probably value destroying. But M&A, which is industry consolidating in the down cycle, is probably value enhancing. So that's the other, and I think if you can find managers who are prepared to act in a contrarian way to their industry capital cycle, and in that in Capital Returns book, I included a piece. I can't quite remember the name of the company, of a Finnish financial services company in which the manager had divested financial services businesses, put some of his insurance company, raised the cash assets of the insurance companies rather than equities and so forth. So he was playing the capital cycle well. The other thing, and one of the reasons this guy was playing it well, is that he had a large stake in the business. So I don't think that helps you in itself, because you have cases like Lehman Brothers where they had huge equity stakes, and Glencore guys lost a lot of money, but they had clearly they had very, very big stakes in these businesses. But having it may not guarantee you safe that the management is aligned. But if management is not aligned at all, that can they're likely to be more perverse in regards to the capital cycle.
Right. So a bonus question we always ask is for a book recommendation, and typically we're looking for something that's a little under the radar and maybe hasn't gotten the due that you think it might deserve. What do you have for us today?
God, I've been reading. What have I been reading? I mean, this last week I've been reading about the Argentine crisis of the 1890s. I mean, I may have it on my book, but actually, I'm upset. The thing that interests me at the moment Well, one of the things that's interesting me at the moment is interest rates and capital flows. And so the book I read, which is by this fellow called Marichal, Marichal, is called A Century of Latin American Debt Crisis, from 1820 to, sort of 1820. I think it's 1820 to 1840. But actually what's marvelous about it is it's a very well-written book. And it describes capital flows and the behavior. And take the bearings, the Argentine crisis, or what we in England call the Barings crisis, because in 1890 Barings Bank went down, which was sort of the Lehman moment of that of that century, and you see the capital inflows going into emerging. You see low interest rates in the US and in the UK, relatively depressed economies in the UK and the US. A nice big fat carry trade into Argentina and Uruguay, and then the money being well, first of all, then a huge building boom, and a huge amount of corruption and so on and so forth. Now, it seems to me that that this last leg of the cycle post Lehman has really, most of the rubbish, most of the bad things have been going on in the emerging markets, and largely driven by this capital flows. So I think you could read that book, but I think that book's difficult to get hold of. I'm trying to look at my shelf. I read Kindleberger wrote a good brief book on international capital flows. There's another. Now I'm trying to see. There's another good book that I read by someone called Harold James, and he wrote a book. Yeah, I've got it here. It's called The End of Globalization, and that really looks at what happens. It's called Lessons from the Great Depression, and it was published by Harvard in 2001. Now this is about how globalization broke down on the reversal of capital flows in the early 1930s, and I think that's a pretty good book. So I mean, if you wanted to read other stuff on the same subject, I mean Reinhardt and Rogoff have a bit of it in their book. But yeah, so that's really what I've been thinking about recently. One other thing, if your listeners, reading about the Argentine crisis got me looking back at David Kinnison's History of the City of London. Have you ever read that?
No.
Because it's no small undertaking, because this is it's a 5-volume work. each volume is about 500 or 600 pages, but it's divided into periods. The first period is early 19th century, and the second period is sort of 1890 to 1914 or thereabouts. Anyhow, the point is, it's actually stupendously well written, very funny. But if you have an interest in, like I do, in how the relationship between what's going on in the financial world and the speculative booms and busts that come about, I do think if you haven't read it, I would just. That would be my top recommendation. Is for your for any of your listeners to start with Kinnison's first volume of the History of City of London. I can't quite remember its actual title. And if they get a taste for it, and I think it's really one of the best books, one of the best books on finance ever written. But if they get a taste for it, then they've got four more volumes to go through.
Well, Edward, we really appreciate coming on the show. It was really fascinating to chat with you.
Good. Well, it's been a pleasure. Nice speaking to you. I'm glad you got your copy of Capital Returns in the end.
Oh, yeah. Thank you.